All right, let's get right into it. Today, we're digging into Penguin International's latest full-year results. And look, on the surface, the story seems amazing. But you know us, we're going to peel back those layers and find out what's really going on under the hood. Okay, so take a look at this. Wow. The stock has just gone vertical, absolutely crushing the market. When you see a run-up like this, you have to ask, right? Is the business actually doing that well, or is something else driving this incredible price? That's the big question, Alex. And before we start unpacking it, Bun here, let's just ground ourselves with some of the basics. So we're looking at a company with a market cap of just under 400 million Singapore dollars. And for you dividend investors, it's got a forward yield of about 2.7%. Just some key numbers to keep in the back of your mind. So here's how we're going to break it all down. We'll start big picture, then hit the good news about their revenue. After that, we'll talk about the catch, the quality of their profits, and solve a little cash flow puzzle. Then it's all about the future, risks versus opportunities, and we'll wrap it all up with a final checklist for investors. Sound good? Let's jump in. All right, first things first, let's talk about the good news. And honestly, it is really good. I'm talking about the top line, their total revenue. The company had some fantastic momentum this past year. For the full year 2025, revenue jumped up by 13.2%. That brings them to 267 million Singapore dollars. You really can't argue with that. It's a super strong signal that demand is there and the business is growing. So on that front, everything looks great. Yeah, but this is where the plot thickens, right, Alex? Because with all that extra money coming in the door, you'd think profits would be flying high too. Well, that's not exactly what we see. This is the catch we were talking about. Because despite that awesome double-digit revenue growth, their operating profit, it barely budged. We're talking just a 1% increase. And that, right there, that disconnect between sales and actual profit is why we can't just call this a straightforward win for investors. Exactly. So that's the million-dollar question, isn't it? What on earth happened between that big revenue number and the tiny profit number? Where did all that money go? It's like it just disappeared. Well, it's like a financial tug-of-war was going on. In one corner, pulling profits up, they had this big $12.2 million gain from selling off some of their vessels. And yeah, that's real cash. But it's a one-time thing, right? You can't count on that every year. But in the other corner, pulling profits down, they took a nearly $5 million hit from foreign exchange losses. So you've got these two big, unusual items that just muddy the waters and make it really hard to see how the core business is actually performing. And that brings us to this quote from the report, which just nails it. It says the earnings were real but not clean. I love that phrasing. The money is there, but it's not from their day-to-day operations. It's dirty in a financial sense, you know? You have to look past all that noise from the vessel sales and the currency stuff to get to what's really happening. Okay, but underneath all that noise, there's a really interesting story unfolding about how they make their money. Back in 2024, if you look at their business, it was basically all about shipbuilding. It was almost 80% of their entire revenue. Chartering out vessels, that was just a small sideline. But now, fast forward just 1 year to 2025, and you can see a real shift. That chartering business grew like crazy, almost 47%. And now it's more than a quarter of their total sales. That's a great sign, right? It shows they're not just a one-trick pony anymore. Hold on, though. There's a really important but here. Even though chartering is the flashy, fast-growing part of the business, shipbuilding is still where they make the real money. It's the profit engine. In 2025, it brought in about 4 times more profit than the chartering side. So yeah, their sales are getting more diverse, but when it comes to the bottom line, it's still the shipbuilding show. And that leads us to maybe the most important part of this whole analysis, cash flow. Because as any investor knows, profit on a spreadsheet is one thing, but actual cash in the bank is what really matters. So let's dig into that. Right. So if you just looked at the headlines, you'd see a net profit of $35.5 million for the year. Looks pretty good on paper. It does, but then you look at the cash flow statement and you see a different picture. The actual cash they generated from operations was only $29.8 million. So there's this $6 million gap between the profit they claimed and the cash they actually collected. So the big question is, why? Where's the disconnect? Figuring this out is crucial if you want to know how healthy this company really is. Well, it really comes down to something called working capital. Think of it as the money they need just to run the business day to day. And a huge chunk of cash, over $27 million, got tied up in building new ships that haven't been sold yet. That's inventory. Now, they did get some cash in from good timing on customer payments, which helped, but the takeaway is that their cash generation is really lumpy. It's not a smooth, predictable stream. It got better this year, but it all depends on when these massive, expensive projects start and finish. Okay, and to understand one of the risks here, we need to talk about something called contract liabilities. It sounds technical, but it's actually pretty simple. It's basically the customer's down payment. It's money they get upfront for work they haven't finished yet. You can think of it as a nice customer-funded safety cushion, and obviously, the bigger that cushion, the better. Exactly. And this is where we see a bit of a warning sign. That cushion, it got a lot smaller in 2025. In fact, it dropped by almost a third. What that means is they ended the year with a lot less cash up front from their customers than they started with. Now, it's not a full-blown crisis, but it's definitely a risk to watch because it gives them less breathing room. So, when you take a step back and look at the whole picture, what does the future look like? It really feels like a classic balancing act between a big opportunity and some pretty clear risks. Yeah, it really is. The opportunity is obvious, right? This chartering business is growing fast, and it's giving them a real second engine for growth, which is fantastic.
But, and it's a big but, that growth costs a lot of money. It takes a ton of disciplined spending. And where's that money coming from? It's coming from the old, reliable shipbuilding business. So for this to work, those two parts of the company have to be perfectly in sync. It's a delicate dance.
Okay, so let's boil this all down into a final checklist for any investor watching. These are the absolute must-knows from today's analysis. First step, revenue is growing strong, but the core profit is kind of stuck in neutral.
Right. And the profit we do see is a mixed bag, propped up by those one-time vessel sales.
The move into chartering is great for the business mix, but let's not forget, shipbuilding is still paying all the bills.
And finally, cash flow is looking better, but it's unpredictable and tied to the timing of huge projects.
So the bottom line is this. Penguin is a company smack in the middle of a transition. There are some real strengths here, for sure, but there are also some very clear risks that you've got to keep a close eye on. And just as a final note, this content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.